Ever wondered how your investments are really working for you? Not just, oh, I put money in and it grew, but the nitty-gritty, behind-the-scenes magic that decides what those investments actually are? Today, we're pulling back the curtain on one of Canada's most popular investing platforms, Wealthsimple. We're going to dive deep into a question many of you have asked: how exactly does Wealthsimple choose your portfolio? It's a crucial question, because in a world saturated with investing apps and platforms, it's easy to feel like you're just a number, your money a data point in a vast algorithm. But truly understanding how your portfolio is constructed and the philosophy behind those choices empowers you. It turns you from a passive participant into an informed investor, ready to make smarter decisions about your financial future. Before we jump into the mechanics, let's set the stage. For those unfamiliar, Wealthsimple is a robo-advisor. What does that mean? In essence, it's an automated investment service that uses algorithms to build and manage diversified portfolios based on your financial goals and risk tolerance. Gone are the days of needing a traditional human advisor for every minor decision. Robo-advisors make investing accessible and often more affordable. But automated doesn't mean random. There's a sophisticated system at play, a framework built on established financial principles and a deep understanding of market dynamics. So, how do they translate your personal information into a tailored investment strategy? It all starts with a very personal, yet powerful, questionnaire. When you first sign up for Wealthsimple, you are presented with a series of questions. These aren't just for show, they form the bedrock of your personalized portfolio. Think of it like a financial fingerprint. They ask about your financial goals. Are you saving for retirement, a down payment on a house, your child's education, or just looking to grow your wealth generally? Your time horizon is equally important. How long do you plan on keeping your money invested? Is it 5 years, 10 years, or decades? This directly impacts the level of risk suitable for your portfolio. Then comes the critical part, your risk tolerance. This isn't about being a daredevil or a shrinking violet, it's about understanding your comfort level with market fluctuations. Can you stomach seeing your portfolio drop by 10% in a given month, knowing that over the long term, it's likely to recover and grow? Or does that thought send shivers down your spine? Wealthsimple gauges this through a series of questions that explore your past investing experience, your reaction to hypothetical market downturns, and your overall financial stability. They might ask things like, if your portfolio dropped by X%, what would you do? Your answer helps them understand if you're more likely to panic sell or ride out the storm. Now, why is this risk assessment so vital? Because risk and return are inextricably linked. Generally, higher potential returns come with higher risk. A portfolio with a greater allocation to stocks, equities, will have more growth potential but also more volatility. A portfolio heavily weighted towards bonds will be more stable but offer more modest returns. Wealthsimple uses your risk tolerance to find that sweet spot, balancing your desire for growth with your comfort level for risk. They don't want you losing sleep over your investments, but they also want to ensure your money is working hard enough to meet your goals. Once they've gathered all this information, Wealthsimple's algorithms spring into action. They don't just pick individual stocks or bonds at random. Instead, they build portfolios using exchange-traded funds, or ETFs. This is a crucial distinction. ETFs are essentially baskets of various investments, stocks, bonds, commodities, that trade on stock exchanges. By investing in ETFs, you instantly get diversification across different companies, industries, and even countries, without having to buy each individual asset. Why ETFs? Because diversification is paramount in investing. Putting all your eggs in one basket is a recipe for disaster. If one company or even one sector struggles, your entire portfolio takes a hit. ETFs spread your risk, meaning that if one part of the market underperforms, other parts can compensate. This smooths out the ride and helps protect your capital. Wealthsimple's core portfolios are typically composed of a mix of equity ETFs and fixed income, bond, ETFs. The exact percentages of each are what define your personalized portfolio. For a low-risk investor, the portfolio might be heavily weighted towards bonds, perhaps 70 to 80% bonds and 20 to 30% equities. This offers stability and a steady income stream, albeit with slower growth. For a high-risk investor, it might be the inverse, 70 to 80% equities and 20 to 30% bonds, aiming for aggressive growth with the understanding that there will be more significant ups and downs. Most investors fall somewhere in the middle, with a balanced portfolio. Let's delve a bit deeper into the types of ETFs they might use. For equities, Wealthsimple often utilizes ETFs that track broad market indices. Think of an ETF that tracks the S&P 500, giving you exposure to the 500 largest U.S. companies. They also include international equity ETFs to provide global diversification. This isn't just about putting your money in Canadian companies, it's about investing in the global economy. By including international markets, you reduce your reliance on any single country's economic performance and open yourself up to growth opportunities worldwide. On the fixed income side, they use bond ETFs. These can include government bonds, corporate bonds, and even international bonds. Bonds are generally less volatile than stocks and provide a stable income stream. They act as a ballast in your portfolio, providing stability when stock markets are turbulent. When equities are down, bonds often hold their value or even increase, helping to cushion the blow to your overall portfolio. Now, it's not just about the initial allocation. Markets are dynamic. Economies shift, companies grow and shrink, and your own financial situation might change. This is where the robo part of robo-advisor really shines, rebalancing. Over time, the initial target allocation of your portfolio can drift. If stocks perform exceptionally well, your equity allocation might grow beyond its target percentage, making your portfolio riskier than intended. Conversely, if bonds outperform, your fixed income allocation might become too large. Wealthsimple automatically rebalances your portfolio periodically. This means they sell off a small portion of the assets that have performed well and use that money to buy more of the assets that have underperformed, bringing your portfolio back to its original target allocation. This is a crucial, often overlooked, benefit of robo-advisors. It enforces a disciplined investing strategy, ensuring you're not taking on too much or too little risk, and it essentially forces you to buy low and sell high in a systematic way. With that said, thanks for watching and until next time.